Welcome back to the deep dive. Our mission here is to take that complex stack of financial reports, analyst notes, and market intelligence, really, the fire hose of data, and distill it into the crucial knowledge you need.
And today, we are undertaking a really critical and, I think, very detailed follow-up. We're returning to Heineken Malaysia, Bursa, or HEIM.
HEIM, yeah. A structural market leader whose resilience is, well, it's about to be seriously tested. This deep dive directly builds on our previous analysis of their Q2 2025 results.
Which were, you'll remember, quite challenging.
Exactly. That session, and you can still find it on our channel, detailed the consumer caution and that initial drag from the big strategic investments HEIM was making mid-year.
Right.
So our mission now is to really dissect their latest results, this powerhouse Q3 2025 financial update, and compare it against that more moderate Q2 performance.
And we'll use the analyst commentary to determine the true underlying strength of this business. We really need to see if their foundational moat can absorb this regulatory shockwave that is now hitting the sector.
It's the classic battle, isn't it? Internal efficiency versus these huge external pressures.
It is. We're specifically assessing whether HEIM's operational controls and that pricing power, which, by the way, delivered a record Q3 recovery, are robust enough to counter the significant, imminent excise duty hike.
The stakes are high. And the numbers. The numbers are fascinating.
They really are.
Absolutely. Okay, so before we plunge into the detailed mechanics of that financial rebound and, analyze the strength of that financial moat, we have a quick but really important favor to ask. If you find this analysis helpful, please take just a moment right now to hit the like button on this video, maybe drop a comment with your own thoughts on HEIM's strategy, and subscribe to the channel.
You make sure you catch all our deep dives.
It does, and that support is genuinely what allows us to keep spending the time needed to bring you this level of detail.
Okay, let's get into it.
All right, segment 1. Let's unpack this dramatic shift. If you followed our previous analysis on Q2, we were talking about a narrative of moderation.
We were. Slowed revenue growth, those higher digital operating expenses, and a degree of consumer anxiety. The market sentiment was cautious at best.
And then Q3 happened.
That narrative performed a complete 180 in Q3 2025. Analysts across the board recognized this shift. They called it a spirited earnings recovery.
A spirited recovery. I like that.
It fits. And this rapid quarter-on-quarter turnaround is, in itself, a testament to management's agility.
Let's talk numbers, because they are just dramatic. Q3 revenue didn't just stabilize, it surged. 22% quarter-on-quarter.
It hit RM 656.00 million.
That is a massive bounce back from the RM 539.7 million we saw in Q2. How did they achieve that kind of acceleration in just one quarter?
Well, it wasn't purely volume, though volume certainly did recover as some of that earlier consumer caution faded.
Okay.
The key driver here was a combination of things. Strategic price revisions, which we'll get into, coupled with extremely disciplined sales execution, especially with their premium portfolio.
So they're not just selling more, they're selling smarter.
Exactly. When you see a revenue surge that big, it often signals successful inventory replenishment across the channels after a period of, understocking.
Yeah.
And of course, that effective price passed-through.
But the profit metrics, that's where the recovery story truly elevates, right? Profit before tax, or PBT, it jumped an even more remarkable 36% QOQ.
Up to RM 148.8 million. And net profit mirrored this, surging 36.1% QOQ to RM 112.9 million. That's way up from Q2's 83 million.
So the critical thing here, the thing to really notice, is that profit growth massively outpaced the 22% revenue growth.
That gap, that's the defining feature of this quarter. The 36% profit growth versus 22% revenue growth. It's the ultimate sign of operational leverage at work.
Explain that for us, operational leverage.
It means that once your fixed costs are covered, things like plant maintenance or certain salaries, any extra revenue drops to the bottom line at an accelerated rate.
So every extra dollar sales is more profitable.
Much more profitable. In HEIM's case, their aggressive cost control and pricing strategies allowed a much higher proportion of that 22% revenue surge to translate directly into profit. It just proves their efficiency machine is finely tuned.
And the ultimate proof of that efficiency is the margin. The PBT margin expanded to a truly exceptional record high of 22.7% in Q3.
A record high.
This wasn't just recouping losses, this was setting a new standard of profitability for the company.
Absolutely. That 22.7% margin is the single most compelling data point. It confirms HEIM's immense pricing power and efficiency.
To achieve that in a market like this, so highly taxed and competitive,
It requires near-perfect execution across the board. Supply chain, procurement, commercial strategies. It just underscores that the price adjustments and that continuous drive for cost optimization successfully neutralized rising costs and that digital investment drag we flagged last time.
So Q3 was the spectacular short-term bounce. Let's zoom out. What about the year-to-date performance? The first 9 months of 2025 versus the same period last year.
Right, looking at the top line, 9M25 revenue was largely stable. It was actually marginally lower by just 0.7% at RM 1.96 billion.
So essentially flat year over year.
Exactly. This confirms that while Q2 was soft, the strength of Q1, which was boosted by the early Lunar New Year sales, and this Q3 recovery acted like bookends. They'd successfully mitigated the mid-year softness.
But what's fascinating is the profit trend over those 9 months. Despite that flat revenue, 9M25 PBT actually rose by 2% to RM 419.1 million.
It's the same core mechanic we saw in Q3, just viewed over a longer period.
Margin expansion again?
The 2% PBT growth was driven entirely by a 0.6 percentage point margin expansion across those 9 months.
So they sold roughly the same amount of product.
But extracted more profit per unit sold. It's all thanks to aggressive cost discipline, procurement savings, and those early price adjustments. This consistency, even when volume is static, it really speaks volumes about the quality of the business.
Okay, now here's the nuance that could trip someone up, just looking at the headlines. 9M25 net profit fell 2.4% to RM 318.1 million, even though PBT rose. We have to dissect that.
This is a classic accounting nuance. And it's absolutely vital to understand this has nothing to do with core operational health. The drop was entirely due to effective tax rate, or ETR, normalization.
Okay, break down ETR normalization in practical terms for us.
Think of it this way. In the prior year, 9M24, HEIM's ETR was exceptionally low. It was just 20.5%.
Why so low?
That low rate was achieved because the company utilized reinvestment allowances. It's essentially a temporary tax break you get for injecting capital back into the business, like for facility upgrades.
So they were temporarily paying less tax because they were spending strategically on the business.
Precisely. But those temporary allowances, they eventually run their course. In 9M25, the ETR reverted to a more standard statutory rate of 24.1%.
So they just paid a higher, more normal tax bill this year.
Correct. So even though their operating profit, the PBT, was robustly higher, the increased tax payment pulled the final net profit figure down by 2.4%.
And for analysts looking at long-term strength,
they're focused on the 2% PBT growth. They recognize that the net profit dip is a temporary, non-operational tax effect. This distinction is crucial for valuing the stock correctly.
Right, so the operational story remains incredibly strong. Let's dig into the strategic countermeasures that got them there. What specific levers did HEIM pull to achieve that staggering 22.7% PBT margin?
There were 3 core pillars. First, and most obviously, the price revisions. HEIM strategically implemented price adjustments from 2% to 8%.
And they rolled this out tactically.
Very tactically. First, the on-trade channels, pubs, restaurants in August, then the off-trade channels, supermarkets, convenience stores in September. These are mandatory to offset the cost pressures.
Pricing power is a huge advantage, but raising prices always carries a risk. You could scare off consumers. How confident are they that they won't see a huge drop in volume?
They rely on a proven structural characteristic of the beer market. Relatively inelastic demand.
Inelastic demand.
Yes. Their own research and analyst models place the elasticity coefficient at approximately 0.94.
Break that down for us. What does 0.94 actually mean?
Certainly. If demand were perfectly elastic, so a coefficient of 1.01% price increase would lead to a 1% drop in volume. Simple.
Okay.
But at 0.94, if HEIM raises the price by 1%, the resulting drop in volume is only 0.94%. So for every dollar of price increase, they keep more of their volume than they lose.
So the consumer grumbles, but they still buy?
Mostly, yes. The brand loyalty, the habit that inelasticity means consumption, will quickly normalize. It supports their confidence in passing through costs. And this structural advantage is a massive part of their financial moat.
So that supports the revenue side. What about the cost side? What drove that aggressive efficiency?
We have to emphasize cost discipline. Analysts credit HEIM with continuous efficiency gains, robust cost optimization, and favorable input costs. Think raw materials and favorable foreign exchange movements.
So it's not just one thing.
No, it's tightening every link in the chain. Rigorous management of marketing spend, shifting to higher return digital channels, improving supply chain logistics. To get to a 22.7% margin, every part of the business has to be firing on all cylinders.
Okay, let's pivot back to the investment that caused some pain back in Q2, the digital rollout.
Right, the digital backbone and easel platforms, which are part of their overarching evergreen strategy.
This is their long-term competitiveness play, but it has a short-term cost.
It does. Evergreen is their roadmap for future-proofing. The digital backbone is about using data and cloud infrastructure to make internal processes faster and smarter.
And easel.
That's their enhanced B2B platform for retailers to manage orders, inventory, payments, all of it, seamlessly.
Last time we noted analysts flagged this as a red flag because of the higher operating expenses, the OPEX. We saw that in Q2's PBT drop. Did they pull back on the spending to boost Q3's numbers?
Not at all. And that's the key point. The investment is strategic and long-term. This confirms the fundamental strategic trade-off HEIM is making.
Short-term pain for long-term gain.
Exactly. Management is consciously accepting a short-term OPEX drag, which hits near-term PBT, in exchange for securing massive long-term operational strength. They're prioritizing future competitiveness over maximizing this quarter's profit.
Does the market get that? Are investors patient enough for that kind of trade-off?
Generally, yes. The analysts who cover them view this investment as necessary. The potential benefits, better demand forecasting, streamlined order management, superior efficiency, they far outweigh the current pain.
So they're building a better ecosystem.
A better, more technologically advanced ecosystem. And that is a crucial element of their non-financial moat. It ensures they maintain market leadership.
Okay, let's move from internal strategy to the undeniable external risk, the regulatory environment. Let's talk about the elephant in the room, the excise duty hike.
This is the sector's key risk, and the details are now fixed. Effective November 1st, 2025, the excise duty on alcoholic beverages rose by a sharp 10%.
10%.
This raises the duty rate to RM 192.50 per liter of a 100% alcohol content.
That sounds like a heavy hit. What does that 10% hike actually translate to for HEIM's operational costs?
It's significant. Excise duty isn't some small component. It typically accounts for a massive 58 to 60% of a brewer's cost of goods sold, or COGS.
Wow.
So analysts estimate this 10% duty increase translates directly into a 5.8% to 6% increase in HEIM's overall COGS. That is a substantial pressure that has to be managed or passed on.
Which reinforces the need for those price hikes we just talked about.
Absolutely.
Given this guaranteed cost increase, the stock's trading around RM22, yet analysts overwhelmingly argue this risk is already priced into HEIM's valuation. How can they be so confident the market has fully discounted the bad news?
It comes down to historical perspective. HEIM is currently trading at a forward price-to-earnings ratio that is substantially below its 5-year historical average.
And that average is?
It's around 22.3x PE. The fact that it's trading so much lower suggests investors have already baked in the expected impact of the hike and the volume disruption. The bad news is, theoretically, already in the price.
But I have to challenge that. If the stock is so far below its historical average, doesn't that suggest the market might be overestimating the severity of the impact? Or maybe underestimating the resilience that we just saw in Q3?
That is precisely the debate among investors right now. The analysts with a buy rating are arguing the market is being overly pessimistic. They think it's focusing too much on the short-term regulatory gloom.
And the counter-argument?
The counter-argument is the illicit trade problem. Every time legal prices go up, the black market becomes more attractive. If the market believes illicit trade will erode more than 6% of legal volume, then maybe the discount is justified.
But based on HEIM's proven pricing power,
the consensus leans towards the market over-discounting their structural strengths.
Okay, let's talk about immediate mitigation strategies. How do they cushion the volume hit in Q4 post-November 1st?
2 key cushions. The first is front-loading.
Stocking up before the price goes up.
Exactly. Retailers, wholesalers, everyone knows the duty hike is coming. So analysts expect a massive preemptive stocking of inventory in October.
So Q4 might look artificially strong.
It's expected to drive a sequentially stronger Q4, yes.
Right.
Essentially, it borrows sales from early Q1 2026, which cushions that immediate post-hike slump.
And for the longer-term volume support?
They're relying on macro factors. The key one is the government's commitment to Visit Malaysia year 2026.
More tourists, more sales.
Accelerated tourist arrivals translate directly into higher on-trade and off-trade consumption. You combine that with year-end festivities, and those are the critical external factors they're hoping will offset any temporary, price-sensitive volume declines.
But every time the legal price goes up, they face the structural issue of illicit trade.
This is a persistent and highly damaging non-financial risk. Higher legal prices create an irresistible margin for illegal alcohol. It erodes the legal market and the government's tax base.
What are they doing about it?
They take it very seriously. They're collaborating with authorities, participating in the multi-agency task force to clamp down on contraband. It's a necessary battle, but it represents a structural ceiling on growth that's tied directly to excise policy.
And one final risk before we move to the Moat score, an update on the material litigation the company has been facing.
All right, this is still an ongoing issue to monitor. The trial started back in November 2024. There have been periodic hearings, March, August, September of 2025. And the next scheduled hearing is set for this month, November 2025.
Any material developments?
Nothing adverse was reported in the Q3 statement, but the litigation is costly, it requires management attention, and it remains a background risk that creates some uncertainty until it's resolved.
Okay, let's pull all this together and evaluate the company's structural defenses. Despite everything we've talked about, HEIM earns a high financial moat score of 8.0 out of 10.
And that score hinges entirely on that demonstrated structural resilience.
Yeah.
The thing that was so powerfully proven by the record Q3 efficiency.
Right.
The company that can achieve a 22.7% PBT margin right after a soft quarter and just before a massive tax hike. That company possesses a formidable competitive advantage. The moat is what allows them to manage a 6% COGS increase.
So let's itemize the key factors that justify an 8 out of 10, starting with the margin moat.
Market leadership and pricing power, it's paramount. And the single most important piece of evidence is that record 22.7% PBT margin.
The proof is in the numbers.
It's concrete proof of successful cost pass-through, sustained by their duopolistic market position and that price inelasticity we discussed. They can dictate pricing terms without fear of proportional volume loss. That is a true moat.
Okay, next up, financial flexibility. Let's talk about their cash flow.
The foundation of flexibility is strong cash generation. AGA is a cash machine. Net cash from core operating activities is robust, sitting at RM 320.225 million for the first 9 months of 2025.
That's a huge buffer.
An immense buffer against external shocks, and it's what supports their famous dividend track record.
Now, let's tackle the debt structure, because this is where the nuance is really essential. In our last deep dive, we noted that at the end of Q2, the company had 0 outstanding long-term debt. Did that hold?
The structural zero debt status largely held, but we have to clarify the Q3 update. As of September 30th, HEIM reported RM 170 million in current unsecured borrowings.
Wait, from 0 to 170 million in 3 months. Is that a sign of pressure?
No, and this is the key distinction between structural leverage and operational efficiency. This is short-term debt with a very brief tenure, typically 4 to 8 weeks.
So it's working capital management.
It's highly efficient working capital management. It's often used to bridge the gap between paying suppliers and receiving payment from retailers. They use cheap, short-term credit to maximize the speed of their operations without tying up long-term capital.
So it's not a sign of distress, it's actually a sign of financial sophistication.
Precisely. It allows them to maintain high operational efficiency without incurring the costs of structural long-term debt. Their balance sheet remains overwhelmingly strong and flexible.
Beyond the pure financials, what about their ESG resilience? How does sustainability contribute to the moat?
ESG is becoming non-negotiable for stable long-term operations. HEIM scores highly here, a 3.3 out of 4, which is rated as excellent or good. And their commitments are tangible achievements, not just paper promises.
Give us some examples.
2 great ones. First, they've achieved zero waste to landfill since 2017. That is years ahead of many global peers. It materially reduces disposal costs and future regulatory risk.
And the second?
Their commitment to using 100% renewable electricity via the Green Electricity Tariff Program since March 2022. This hedges them against future energy price volatility and enhances their reputation. These actions future-proof the supply chain.
So if the pricing power is immense, cash generation powerful, balance sheet flexible, and ESG strong, why not a perfect 10 out of 10? What brings the score down to an 8?
The coins are docked entirely due to external realities. First, high concentration risk.
100% of sales in Malaysia.
Exactly. Any domestic regulatory shock hits them fully. Second, the persistent regulatory risk itself, which is volatile. And third, the constant debilitating threat from illicit trade, which undermines their market every time they raise prices.
Let's use the competitive landscape to highlight that concentration risk. When you compare HEIM to its main peer, Carlsberg.
That's the critical comparison. Analysts often flag HEIM's Malaysia-only exposure as a competitive vulnerability. Carlsberg, on the other hand, benefits from having about 30% of its sales revenue diversified through Singapore.
Why does that 30% in Singapore matter so much?
It acts as an essential hedge. Singapore's economic and regulatory environment is stable and independent of Malaysia's. If Malaysia raises excise duties, the impact on Carlsberg's overall group P&L is softened.
Because 30% of their revenue base remains stable.
Right. HEIM lacks that diversification. It means they have to achieve even higher operational efficiency domestically, which, to their credit, that 22.7% margin shows they're trying to do to mitigate the full force of domestic policy.
Despite all these headwinds, the concentration risk, the excise hike, the Analyst consensus is overwhelmingly unified. All the key research houses, RHB, TA, HLIB, they all maintain a confident buy rating. Why?
They cite 3 reasons that anchor long-term value, reasons that transcend the short-term news cycle. First, undeniable brand leadership and market dominance. Second, the proven strong pricing power, which was just validated by Q3. And third, the consistent dividend track record.
The yield is very attractive.
The projected FY26 forward yield is forecasted around 7.2%. In a volatile market, that kind of reliable cash return is a massive draw for income investors.
Let's drill down into the valuation metrics that support this buy call. The current price is around RM22. Where do the analysts see the upside?
The consensus target price, or TP, is significantly above that, landing at RM27.90. Individual analysts all see substantial upside. RHB's TP is MYR 26.5.
And they add a premium for ESG.
A 6% premium specifically for their strong ESG performance, yes. TA Securities pegs it at RM24.00 based on a DCF model, and HLAB offers RM27.14.
So this implies a major conviction that the stock is undervalued right now.
It does, and the critical context is the valuation discount. TA Securities highlights that AIM is trading at 14.8 times CY26 PER.
Which is drastically below
its 5-year historical average of 22.3x. This massive valuation gap is driven by short-term market anxiety about the excise hike. Analysts believe the difference between RM22 and RM27.90 is justified by HEIM's structural note and the expectation they can sustain profitability and dividends.
So the message is clear. The current low price is a function of fear, not a reflection of fundamental weakness.
Exactly. The powerful operational resilience we saw in Q3 confirms that HEIM is an efficient machine capable of passing through costs. For long-term investors, the current pricing offers an opportunity to buy a market leader at a substantial discount to its own history.
You're betting on that underlying strength to ultimately override the regulatory noise.
That's the thesis.
To summarize this deep dive into Heineken Malaysia Berhad, the Q3 rebound was just an exceptional demonstration of operational resilience and pricing power, backed by that impressive 8 out of 10 financial moat.
It really confirmed the company is structurally equipped to handle immense external pressure.
But we cannot ignore that as we move into Q4, the regulatory pressures, specifically that 10% excise duty hike, are now fully in effect.
So given the powerful moat, which was validated by that record PBT margin, and the significant valuation discount relative to its history, the question for you to consider is this. In an industry where pricing power and inelastic demand define structural strengths, are investors currently focusing too heavily on the short-term shock of the excise duty? Or is that temporary market-wide fear creating an ideal entry point for long-term value appreciation?
A profound thought to live with. Thank you for joining this deep dive. If this extensive analysis gave you an aha moment or helped you understand the material better, especially that complex ETR normalization or the true meaning of that 810 moat score, please show your support.
Please do.
Comment right now to share your thoughts on whether you agree with the analyst consensus. And of course, subscribe to our YouTube channel to catch all our future deep dives. Until next time, keep learning.
Happy learning, everyone.